Welcome back. This is the latest edition of Solinda Capital Management's Chart Overload. I'm Mumy, and that's JG. And in these, we're going to talk through some exciting charts. Well, I think it's chart overload. Justin doesn't think so. But talk a little bit from our vantage point, what we think it could mean, things we're paying attention to. We appreciate you spending some time with us. But Justin, you ready?
Let's go.
Right. Let's do it. Big picture. Layoffs for October are the highest since 2003. The labor market that we've talked about, could it be cracking a little bit? I don't know. What do you think?
A couple things. First is government shutdown making data much more scarce than it normally would be. So there's not really a lot to look at, but the dominant theme of this past week was there was some alternative data available, and to your point, showing a pickup, or I should say a pickup in job loss, a weakening of the labor market.
Yeah, and then the next one is again from the Challenger report, which has been around forever. It's certainly not the government payroll data, but it's been around a while. There are some trends. This next one just looks at the data by layoffs by industry. What we see here is obviously government education went up. And the rest of the industries appeared to be going down.
Well, you got a bit of a pickup. You've had big high-profile layoffs from Amazon, Microsoft. Many thousands, which is reflected in the fact that information technology is off the lows.
Yeah, yeah.
AI.
Next chart looks at consumer sentiment. This is fresh data, and it's dropped to the lowest point in a little over 3 years.
And a lot, no doubt, has to do with uncertainty in terms of the economic outlook, be it tariffs, etc., but also the fact that inflation has remained high.
Yeah, and a lot of uncertainty in the background. Remember, it's consumer sentiment. It's interviews, questionnaires on what do you think right now about the economy, and right now people are feeling a little blue heading into the holidays. This next one looks at U.S. manufacturing. About every administration for 50 years have talked about trying to rebound the manufacturing sector, and that just hasn't necessarily taken place, and it certainly hasn't been recently.
Nope. Manufacturing has yet to turn up so far based on probably the most followed survey, which is the Purchasing Managers Index. That dotted line would be the expansion point, and as you can see, both key categories are in contraction.
Yeah, but they have been, right? This is back to you and I have talked about this. There's not one silver bullet or aha data point. It's a weight of the evidence. And again, manufacturing has not picked up. So what can we say to that is manufacturing's not helping the economy. But
the question is, what is? And that takes us to the next
here we
one.
go. Thank you. Look at this. You'd think we've done this before.
Cronkite.
Next one looks at the AI investment, CapEx, if you will, and we've talked about this before. There's some big numbers being spent on technology build out.
And this is obviously second quarter because the aforementioned government shutdown will be preventing any data for the most recent quarter yet. But AI CapEx, dominant driver of just overall U.S. economic growth. And I believe we discussed that and showed some graphics last time as well.
Yeah, I mean, it's greater than the consumer, period, right? It's more money coming into the economy than all consumer spending. Next one looks at a breakdown of how the companies are spending and also their own projections for how much they're going to spend on the technology and infrastructure build out. And again, big numbers.
Big numbers that are trending higher.
Yeah, I mean, that's billions. like you see 430, 570, 664. It doesn't seem big, right? But you put the zeros behind it, it's a big number. So, we'll see. These are estimates. Obviously, these companies we think they'll adapt and adjust as things evolve. But all things being equal, if it continues, the numbers will get bigger. Next chart, what could prevent these companies from ramping CapEx is this chart here. It looks at their net income of Alphabet, Amazon, Apple, Microsoft, and Meta. And then it also looks at overlaying that the free cash flow.
Yeah, and if you just looked at this chart in isolation, you could say that net income and free cash flow rose together for a number of years now, but these companies are now choosing to spend a huge chunk, if not increasingly the majority of their profits on the AI CapEx.
And with we've talked about the big question mark is that investors don't necessarily care a lot about now is what type of revenue will this investment start having, start producing, and we just don't know yet. Moving on to domestic stocks, this first chart looks at equal weight as compared to the S&P 500 and the NASDAQ 100.
Yep, and equal weight S&P, so you strip out the disproportionate impact of the biggest of big companies, has continued to lag, which is not a new theme.
Yeah, there's lots of headlines have been around breadth weakening, and your average S&P 500 company has not had the same performance this year as the index or as the Mag 7, the biggest component of the S&P 500. It's the tale of two worlds, if you will. Next chart looks at the Magnificent Seven's forward price to sales ratio, and we've shown this several times, and it keeps going up.
Yeah, I mean, the word would be unprecedented, so we don't want to beat a dead horse there, but with those being the biggest companies that the most people own that are leading the market, it's important to at least kind of know where they stand in terms of valuing against themselves relative to history, back to the cash flow and the net profit.
Correct. Their stock price is going up. Another way to say this, their stock price is going up more than their sales is. Hence, this chart keeps going up. Back to when is the CapEx, the investment in artificial intelligence, going to produce cash flow? We don't know. Next chart looks at.
Let's pause there for 1 second, though. Here's an interesting fact on that number. I don't know if they saw it in the news, but OpenAI just came out and ultimately somewhat admitted that having 700 million daily users is still not close to enough for them to be able to forecast their own profit, let alone the ability to finance all the future deals. So there's going to have to be some levers pulled by big tech to turn this AI renaissance into a moneymaker.
And it may just take time. And the question is, how much time will shareholders give these companies? Because at any point they could say, look, it's taken too long, and sell some shares. We don't know. Next chart looks at earnings reactions. This is fresh data from a week ago. Looks at the different companies when they announced and how the share prices responded.
But to your point, generally positive, with the exception of the orange line being Meta, formerly known as Facebook, came out and was even more aggressive about stating the amount of money they were going to spend on the AI CapEx. And for the first time in several earnings periods, the stock price actually suffered quite a bit on that. So perhaps the investors in Meta are becoming a little bit more discerning about those aggressive spending plans.
To be determined. Next chart looks at small caps relative to the S&P 500, and we've shown this before where it was creeping back up to that horizontal line, looking like it was going to break through, and it didn't, or it hasn't thus far.
Yep. So kind of a head fake, but it looks like the downward relative trend between small companies underperforming the bigger companies, it remains intact.
For numerous reasons we've talked about at length in our past shows, but that trend is not changing. Uh, Again, we talked about equal weight versus S&P and the Nasdaq 100. This next chart looks at consumer-facing companies, and they've been struggling. You strip out Tesla and Amazon, and it looks even worse.
Yeah, which really just goes back to the mega theme that the biggest of big companies spending money on AI has been the driver of the economy for 2, if not maybe 3 or 4 quarters. And it's certainly not the consumer buying more, is what this
Yeah, I
shows.
mean, Chipotle and McDonald's earnings, right? Kind of bellwethers of the consumer from a restaurant standpoint. I mean, their CEOs did not have a lot of rosy things to say, right? And so what's keeping the market up is we've been talking about. There's a massive spend going on, which is real money going into the economy from these big technology companies. Next section, let's look at stocks outside of the United States. First chart looks at, again, we've talked about this before. Domestic shares are underperforming the international peers so far this year.
Yep, year to date, some international outperformance. But we would point out that kind of everything has moved in the same direction. And if you were to look at a longer time frame, which we've showed in recent videos, international has underperformed for a period of time. So it's to be determined and very early innings, if at all. One were to think that money was going to rotate out of the biggest of big U.S. stocks and into those areas sustainably.
If it is, it's just beginning.
Yep.
Next chart looks at Asian stocks specifically. They've had a little rough patch here recently.
So the big Asian markets, in particular Taiwan for semiconductors and South Korea for the semiconductor ecosystem, have been just high flying, along with basically any big companies that are involved with AI. So momentum pullback.
Yeah, and again, was that leading the way to this next chart, which is fresh data, which China's exports unexpectedly dropped, which was a surprise.
And no doubt connected to what we've been showing as a weak American consumer on the margin.
Yeah, I mean, again, and the question isn't like, did this happen? It did. The question is, where does it go from here? Was this a blip, or is this a change in trend? To be determined. Next chart looks at Brazil's America traded ETF that tracks the Brazilian stock market. And as we see here, it's had a pretty good year.
Had a good year, and on a currency adjusted basis, hasn't really done anything for 20 years effectively. But some recent relative strength this week, especially during what has been this big momentum sell-off, which just once again reiterates that this market can move on its own accord, and often does.
Moving into interest rates, the bond market. This first chart just looks at United States Treasuries total return relative to the other G7 countries, fixed income, their own treasury versions performance, and it's been a tale of 2 different halves of the year.
Yeah, general theme really has been after several years of lackluster or notably negative returns, treasuries have given a positive return this year when you include the yield that they pay, and a lot of that really just comes down to the next chart, which is short-term U.S. interest rates. And with the rate cuts by the Fed, 2-year treasury yield in this image has been trending down the whole year.
And you see the kind of jump higher, last couple weeks ago, and that's the Fed kind of changing their the outlook for the remainder of the year, that another cut isn't necessarily in the cards per se.
Yep.
Next chart looks at inflation, and inflation relative to the Federal Reserve cutting rates.
So real interest rates, and as you can see here, the U.S. can go a period of time with positive real interest rates, and then it can go a period of time with negative real interest rates. So we're currently at a point relative to U.S. history. Inflation is high, but rates are still somewhat high relative to at least recent history, I should say. But real interest rates are coming down, which is just the difference between the interest rate minus the inflation, which in this case is CPI. So roughly 1% or less than 1% real interest rates in the US.
Next chart looks at Brazil's real interest rates, and they're pretty high relative to their other Latin American peers.
And especially relative to the US. And as you can see in this chart, that moves around quite a bit over time, albeit they're generally high. Now they are disproportionately high, which makes
Yeah,
sense. It's just the policy trying to support the currency, because in emerging markets, unlike the US, when investors lose confidence in the central bank, the currency usually weakens substantially. So the way to restore confidence is just say, hey, we're going to limit the economy for a period of time and leave rates high.
which back to our chart we just showed on the Brazilian stock market, if real rates in Brazil come down, that could act as a little bit of a catalyst, even more so to their equity markets.
For sure.
Last section, looking at commodities. First chart looks at something that's been in the news, the rare earth metals, and how critical they are to the country. And the list continues to evolve.
Bloomberg headline this week, copper and silver will join the U.S. list of critical minerals. So one would ask, what does that list even mean? And you could say that it might mean the government could announce they're going to start either buying that mineral or just randomly buying mining companies focused on that mineral. And people who are not comfortable with that might say that's not good. People who own those stocks before they're bought by the government, they love it, don't they?
Yeah,
So
they love it. This is a relatively new phenomenon in the United States, where the government taking equity positions in publicly traded companies.
And copper, to the point of this headline, might be increasingly on the radar. So going to the next chart, you see copper overlaid with silver. So silver is the darker colored line. And basically, although they're moving in the same direction, copper had that sharp pullback that we discussed quite a bit earlier in the year. And since then, trades at a bit of a discount to silver.
To be determined. And this final chart looks at old black gold, WTI crude. And as we've discussed, it's been in a downtrend for a year and a half, and it doesn't seem to want to break higher.
No, but it is holding in there at the lows. So, if you just take a step back, you could say that really all the way back to 2021, gold has kind of been in a big giant range. It first went up a lot right into the invasion of Ukraine and has been selling down ever since. Touched a low during the big sell-off during so-called Liberation Day back in April, and has now kind of revisited those levels and is just sort of hanging out there. So interestingly, there's also not any available positioning data to track on oil right now, or commodities in general, because a lot of that reporting is taken offline due to the government shutdown. So not only do you not know where oil is going to go, but you don't even know how people are positioned.
Yeah, right. There will be a data deluge at some point. But anyways, always a pleasure. We appreciate you spending a little time with us. We hope you learned something. If you want to chat a little further, you can always email us at info@solinda.com, info@solinda.com. Check us out on the web, solindawealth.com, SOLLINDA wealth.com. We, again, appreciate you spending some time with us, and we'll be back in 2 weeks.